first time, thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Hey, Will, how are you?
Good. Actually, I'm a little under the weather. I don't know if you can hear it, but I got a little bit of a cold or sore throat. I don't know what's going on.
Yeah, I could kind of hear it a little bit.
Well, let's start with the disclaimer.
Next to you. So. Okay. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you guidance. There's the disclaimer.
Excellent.
And with that, let me share my screen. If you guys are joining us for the first time, we do this show every morning, Monday through Friday, to help answer any questions you may have about the Market Chameleon tools, data, analytics. If you want to come on the show and ask other questions, maybe dealing with strategies or something unusual you've seen, you're welcome to come on the show and ask those questions. We have a link to Zoom. You could click on that link. It's in that YouTube live chat. It brings you over to Zoom. Once you're in Zoom, there's a button, raise your hand, at the bottom of your screen. Click on that. You don't have to turn on your video camera. Once we let you in, everybody could hear you, could ask your question live and direct. If you prefer to type your question in, you could also just type the question on the live chat on YouTube. Will's watching it, he'll read it back to me. While we're waiting for any questions to come in, what we'll do is take a look at the pre-market report, see what's trading at pre-market hours, maybe get some insights with that. We'll give a little bit longer time for more people to come in and ask questions. I can navigate to a different report on the website, or look at something that will give us more market insights. So let's start with the pre-market report, Will, and you let me know if any questions come in.
Perfect.
So the pre-market report, these are stocks that are trading in the pre-market hours. We have a list of the most active stocks, biggest percentage gainers, biggest percentage decliners. Down here, I see 59 stocks made our percentage gainers list and 59 on our decliners. So that from that perspective, we're looking like that the market is neutral at the open. If you look at this list, there are a lot of stocks that are small cap stocks. We also have ETFs in there, closed-end funds, preferreds. Any security that's traded on a major U.S. exchange, if it's trading in pre-market hours and meets our thresholds, it can make this list. So we want to narrow down the list to a smaller group of stocks to see if we could get some insights or some other more focused insights. And what we could do is narrow this list to S&P 500 companies as an example. And to do that, I'm going to use the filters here above. Let's look at an ETF. When you click on that filter, there's a drop down with a list of ETFs. And you can see some of these ETFs. They're going to be like sector ETFs. Up top are the broad-based ETFs. When you select it, so let's do SPY, which is the S&P 500 ETF. Select that. The list below will get filtered by stocks that are holdings in that ETF. Okay, so which are in SPY, that's the S&P 500 constituents. And here we see 5 made our percentage gainers list, 4 on the decliners. So again, looks like a pretty neutral opening right now. Maybe slightly a little bit more bullish because I got some of these stocks that are up in the morning are the higher cap stocks, which will have a bigger impact on the S&P 500. So give it a couple minutes, Will. I don't know if you have any questions yet. If not,
well, there's a lot of chatter about Tesla. They changed their pricing. I don't know if anything's happening in Tesla in the pre-market.
Okay. Yeah, I think I was reading about that. It's their, It's up a little bit. I think it's the second time this year that they've lowered their price, right? They've lowered their price, but Tesla has done that historically, lowered their prices, increased their prices. They really have a unique position, like we were talking about, where the way they sell cars is much different than the traditional other car manufacturers that they go through. They don't go through dealerships. I think you just order it directly from them. They don't really market like Ford and GM. So they could probably have more room, right, to move their prices around. But if there's no specific question on Tesla, I'll just kind of move on. Yeah, you put yourself on mute.
I'm sorry, I was sneezing. Yeah, that's fine. You can move on.
All right. So while we're waiting for any questions to come in, what I think would be interesting to look at is, the big story right now is inflation and how the Fed is trying to tame inflation. And when we think about when there are other parts of our government that can contribute to inflation, right? So there's a monetary side, but there's also a fiscal side. And I'm going to kind of take a look at the fiscal side. We know kind of what the Fed is doing. They're raising interest rates. They're doing a couple other things to slow down the money supply, but for the most part, they're trying to slow down the demand, through higher interest rates. But I'm going to show you guys from the fiscal side, because I think it's worth, paying attention to what's going on from the side of, government spending, and deficits. And this does play into inflation. And we'll kind of first start looking at it. So I pulled up, and I believe this is issued right from the White House. And it's the budget, right? This is their budget, and they give you, I had to jump to page 45, but here's the proposed budget. And they give you also their forecast going out to, looks like 2031. All right. And here, let's just we'll walk through it, and then we'll talk about why this here is also important to inflation, because what they're doing on the fiscal side, and we talked about this I think a week ago, is that after the stock market crash in the Great Depression, we came out with this Keynesian method of saying it's okay to run deficits when unemployment is up and there's deflation, right? So when there's deflation and unemployment, the government can run deficits to boost demand in the economy, right? They need to boost demand, and we've seen that work. They built roads, made investments, they did deficit spending, and that helps the economy. On the flip side, though, when your economy is overheating and unemployment's very low and inflation's high, you need to run a surplus. And to run a surplus, you're either raising taxes or you're cutting government spending to slow down the demand, right, from the government. So the government itself will have to decrease spending to to lower that inflation and ease off the pressures on employment and wage growth. So right now we're in that situation where you would think fiscal policy, the government is either going to slow down it's spending. That's what we're going to do, or raise taxes. And here's what it looks like now. And by the way, deficit spending, it doesn't matter who's in the government. We saw it just seems like there's always deficit spending, right? It doesn't matter who's in control. Like there's really, we kind of have a broken political system because there's really nobody out there that will stop deficit spending, no matter where the economy is. But let's take a look at it, and why would this, start becoming a problem? Where do we think it'll start becoming a problem, and how this will play onto inflation? And here you could see here, they give you, these are the spending, what they're going to spend it on. Here are the receipts, and down here they give you the deficits. All right, so the difference between what you bring in, right, what you bring in versus what you're spending. And let me show you, these deficits, you can see, are projected all the way out, right? All the time. We're just endless deficits. That means we're always going to spend more. The plan is the government will always spend more every year than it collects in tax revenue, right? Which adds to your debt, right? So the debt keeps going up. And then this is what's going to happen over time. So this is our interest right now on our debt, right? So the interest is whatever percentage of the money we bring in. I think it's like 6% or something. So for every dollar we collect in taxes, 6 cents goes to just paying interest. So that's not even, that's not getting spent on any of these social securities, defense, nothing. It has to go. You're obligated to pay that interest. And look what happens as this deficit continues. That means your debt is climbing, right? Which means every year, right? That means our interest is going to also climb because we're just borrowing more money. And at some point, think of it that it's going to start tilting where a bigger and bigger and bigger portion of our taxes are just going to service the debt, service the interest. That means you're going to have less money to pay, right? You're going to have less money for this. You're going to have less money for that because you're paying interest. And what do? You're going to have to either raise taxes, you're going to have to cut, right? Or you're just going to have to inflate. And that's what's playing. It's going to start, being a bigger and bigger factor as you go out. You see how you project. Look, anybody looking at this is looking, well, as far as I could see, there's no surpluses. And if you look at where to cut, look how they project these income taxes, right? That the income taxes every year are growing, which means they're projecting, economic growth, and either wages are increasing or, more people are getting hired to bring in more income tax, right? So every year there's growth. And I think it was like between 6 and 8% a year growth. On the corporate income tax, not as much, but mostly it's coming from individual income taxes. All right. And here's what they project we're collecting, which you could see here. I'm going to show you, these are mandatory programs, right? Here's non-mandatory, discretionary, there's mandatory. So we're getting to the point, where we're already, having a hard time just paying for the mandatory. These are like obligations where we said that we're going to pay, right? Social Security, Medicare, Medicaid, all these we said we are going to pay. These are the discretionary. So we're borrowing against all these. And I think that this here is something important to watch, because over time that continues to put pressure on inflation from this fiscal side. We have a monetary side and we have a fiscal side. And what I'm showing you is that there's nothing the Fed can do, right? They could raise interest rates, which makes some of this even look worse, right? So by raising interest rates, what's happening is we're borrowing every year. That means we have to borrow at higher rates, which makes this part go up. And if the Fed is slowing down demand in the private sector, then this is going to go down. So what's happening is that the one side is telling the other side to fix the problem, right? They're saying, you fix the inflation problem. And the Fed can't fix this problem, right? They can't fix the deficit problem. Only you can do that from the fiscal side. And that here plays into, they're stuck. They're stuck because that is going to continue to put pressures on inflation. Does that make sense? We'll just want to kind of go over your mute.
Very interesting.
Huh?
Can you hear me?
Yeah.
Yeah. No, everyone is very interested in your commentary. It's led to some chat for sure.
Yeah, and look how they see the interest moving up, right? You imagine like in an extreme case where if 100% of every dollar you collect goes to paying interest, right? If that's what it gets, where we collected $1 trillion, but we owe that in interest, then you run out of money to run the government, right? And then what do? Do you have to inflate, or what do you do? And that's why it keeps playing on that pressure, And if you look at these, all these deficits are over $1 trillion per year. Like, they're getting bigger and bigger, right? It's almost like you start becoming immune to these big numbers. You're like, well, if we ran $3 trillion deficit in 2020 and 2021, over 3 trillion, all of a sudden 1 trillion doesn't seem so bad anymore. It seems like almost like you're doing a good job. All right. And again, that Keynesian economics, it says that you need to run surpluses in situations like we're in now, right? Like if we're in situations where you're at full employment and the economy is doing well, you need to be running surpluses, and we're not. And that's going to be a big issue going forward on inflation pressures. So I wanted to show you guys that really quickly. If there are no questions.
We did have a question. They were actually, Laurent was saying that he was looking at, this is how it started. I downloaded the SPY's IV30 from the website. Interestingly, The current IV is 5%, but looking back 2 years, the IV is 41%. And Rob was asking how you actually download that IV information. Could you show him real quick?
For SPY?
Yeah.
So I believe there are a couple ways here. I'm on SPY right now. I think on the historical data. So on this historical data, you have day-to-day, like end of day summary data. On one side, this is the stock data. So you get your open, high, low, close, change, volume, and the VWAP on a day. And then over here, you have the option data. So these are the 30 IV daily closes of the 30 IV. So you could download this from here. And you also get, the option volume and the call open interest, put interest on the day. So you could just download it from here. Will, I think you're mute if you're trying to say something.
Helpful. Just a little side note, your discussion on the government spending. I spoke to two different people, one who's in a electrical union in Philadelphia and one who runs a company that big projects in New York City.
Yeah.
And both of them are saying that they haven't seen such a big slowdown in their space since '08, which I found interesting. I couldn't even imagine that. Like
In a right.
in big commercial jobs, like they thought with the passing of the infrastructure bill, there'd be a lot of money flowing into these big jobs, and certainly on the ground they're not seeing it.
This is like, here, like, look how this is projected, right? These here, the mandatory programs, these are just going to pay, pension, Social Security, Medicare, healthcare, right? And this is interest. So these are not anymore, or this has nothing to do with investments in infrastructure. So that's the other thing. When you're running deficits, the idea was you're using it for investments that will pay off in the future, right? So for example, what do they call the New Deal, where after the stock market crash, the Great Depression, they started building roads and infrastructure. So that deficit spending was boosting demand, plus it was an investment with that would have yield dividends in the future, right? Here, that is not what's going on, right? So these are the non-defense spending here. So you can see it's pretty, maybe what is that, like a trillion, almost a little bit under. And then you got defense spending, right, which is kind of just growing, but it's constant. But the defense maybe has, some of that might go towards like research and development that you could use in the civilian population. A lot of it, I think, our defense spending also pays. It just pays for salaries and soldiers and things like that. So it's not a lot of, if you just take this and these, you're not making big infrastructure investments here with this outlay, right? It's all, we borrowed from Social Security. That was one problem. Now we've got to pay it back. But these costs are going up. And you could see that the money coming in barely pays for that, right? So over here, what do you do with defense? What do you do with non-defense spending? Because you could see here we're spending 1.7 trillion dollars a year, and we don't have it, right? We just don't have the money. We're borrowing it. But if you look at it, you're like, okay, if we're spending 1.6 trillion, you're like, look, but down the road, this is going to, boost our economy with more commerce and, get more people out of poverty and create, things in the future, then maybe you could start justifying it. But, when you're looking at it, there's some of it in there, some of it is in there, but not a lot, not a lot when you look at this deficit. And this deficit is going to go up because our interest rate, every year it's going to keep adding to, maybe when interest rates were we got lucky, it was really low. We had very high productivity for 20 years, but you could see here that this is going to keep climbing and become a bigger and bigger portion of our budget expense. Your interest payments just keep growing every year, more and more. Think of it as like, if you were using your credit card and just paying the interest, right? And you used it again and you're just paying interest, and you used it again, you're just eventually you can't even use it anymore because you could only afford to pay the interest on your balance that you've already spent, right? So your balance already peaked where you cannot borrow anymore because every dollar that you bring in goes towards paying the interest on the balance, and the balance is never going down. So, that's where it starts to create inflationary pressures, and these here projections, it's very hard to project, right? Because what if we do have a recession, that means that you're bringing in less income tax, right? More people unemployed, less individual income tax, less corporate tax. But if your spending stays the same, these numbers are going to look a lot worse, right? So these numbers might look even closer to that. So, that the fiscal side of it's important, right? We've been getting lucky because we had huge productivity growth. We had benefits from globalization. We've had low interest rates where we could refinance and borrow money at lower, but those, factors are changing right now. They don't exist, right? We got interest rates climbing everywhere around the world. It doesn't matter where you look, what country, people are, worried about inflation. There's no, even in Japan's not even stimulating, right? I think Japan is changing their policies because they're a little bit also saying, hey, we might have inflationary pressures here. So
Rob made the comment earlier that I believe this problem exists throughout the world.
It could exist throughout the world, and they're all looking at it, and right. They're like, how do we slow down demand to ease the pressures on inflation? And look, maybe there's always something that could happen that's good that can offset it. Right now, it's hard to see. Right, it's hard to see what would ease off those inflationary pressures that the Fed can start lowering rate, just like the markets right now are pricing in that the Fed's going to start lowering rates again. It's hard to see a situation right now where where they could do
it's amazing because my whole adult life this has been being discussed and nothing's been done about it, right? Ross Perot got Bill Clinton elected running on this platform, right? He was able to get it, 20 some odd percent of the vote because he was, we're borrowing from our children's future. And he was showing everyone teased him because he was showing the graphs, but that was basically his whole platform. So we've got to get this under control. Now we're, I don't want to talk about my age, but it's like 30 years later.
Yeah. I think he ran a surplus. I think Bill Clinton might have been, as far as I could remember, the only president that cut defense spending. I think he cut defense spending and ran in surplus.
There's been a lot of chat. I think Chuck mentioned that in the comments somewhere. I think.
I think he cut defense. He was also lucky because there's huge productivity growth during his tenure. We had that's technological boom. Started really while he was in office. But he did cut defense, I think, and he ran a surplus, maybe even I don't know, at the end of his year, but that's the last surplus we've had in a really long time. And, people think, well, you could do this forever, but, our models, what we're doing, it's still relatively new. We've done a lot of changes since the Great Depression, since 1930s, with getting off the gold standard and we had a lot of dollar strength. These models are not like hundreds of years old that they're running. They could be flawed, and
you think
are definitely constraints. Yeah.
All right. Anyway, well, I loved Alex saying Dima is amazing. Love these discussions. It was a great one. Everyone remember, thumbs up, subscribe below. Always important for Market Chameleon. Great job, D. Thank you.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, communities. Have a great day, everybody. Bye-bye.